You see it all the time. People throwing money into the stock market, chasing the next big thing, only to end up losing their hard-earned savings. It's a brutal reality, but the truth is, most people don't lose money in the stock market because they picked bad stocks. They lose money because of bad psychology. Think about it. How many times have you seen a stock skyrocketing, only to buy in at the absolute peak right before it comes crashing down? Or maybe you panicked and sold your investments during a market dip, locking in losses when you should have held strong. These are classic examples of how our emotions can sabotage our financial success. We get caught up in the hype, let fear dictate our decisions, and end up making costly mistakes. But it doesn't have to be this way. In this video, I'm going to break down the 5 biggest psychological traps that hold new investors back. And I'll give you actionable strategies to rewire your mindset for long-term investing success. Because once you understand the mental game, you can start making decisions that align with your financial goals, not your emotions. Let's be real, we've all been there. You're scrolling through your feed and suddenly everyone's talking about this guaranteed stock tip. Maybe it's a friend, a family member, or even those sketchy gurus promising to make you rich quick. It's tempting, right? You start seeing dollar signs, imagining all the things you could buy if you just threw a little or a lot of money at this sure thing. But here's the thing, if it sounds too good to be true, it probably is. Chasing hype is like playing financial roulette. You might get lucky once or twice, but in the long run, the odds are stacked against you. Remember GameStop? Everyone and their grandma was talking about it. People who had never invested a dime in their lives were suddenly throwing their life savings into a single stock, driven purely by FOMO, the fear of missing out. And what happened? The bubble burst and countless people lost their shirts. The reality is, sustainable wealth isn't built overnight. It's about making calculated decisions, not emotional ones. So how do you avoid the hype trap? Do your research. Understand the fundamentals of the companies you're investing in. Don't just jump on the bandwagon because everyone else is. Remember, slow and steady wins the race. Picture this. You're scrolling through your brokerage account and suddenly your portfolio is bathed in a sea of red. The market is down, maybe even significantly, and that initial feeling of panic starts to set in. It's natural. We're hardwired to avoid losses, and seeing our investments shrink can trigger a primal fear response. But here's the crucial thing to remember. Market dips are a normal part of the investing cycle. They happen. It's not a matter of if, but when. The stock market is like a living, breathing organism, constantly fluctuating in response to news, economic data, and even just plain old human emotion. The problem is, when fear takes over, it can lead to irrational decisions. We sell low, locking in losses, only to watch from the sidelines as the market recovers and our investments climb back up without us. The key to overcoming fear-based selling is to understand that volatility is the price of admission to the stock market. It's the cost of participating in the long-term growth potential of the market. By accepting this reality, you can start to reframe your perspective and avoid making emotional decisions that could derail your financial future. Alright, let's talk about overconfidence, which is a huge factor in why people lose money in the market. You see, it's really easy to get caught up in the excitement of investing. You read a few articles, watch some YouTube videos, maybe even tune into CNBC for a whole afternoon, and suddenly you feel like you're the next Warren Buffett. But here's the thing, even the most seasoned investors with decades of experience can't perfectly time the market. No one can consistently predict when it will go up or down with 100% accuracy. And yet, so many new investors fall into this trap, thinking they've somehow cracked the code. They start making impulsive decisions, buying and selling based on gut feelings or so-called hot tips. This is not investing, guys, it's gambling. And the house always wins. Remember, every time you buy or sell a stock based on a prediction, you're essentially betting against someone else who thinks the opposite. And those someone else's are often institutions with way more information and resources than you have. They have algorithms, analysts, and years of data at their fingertips. So, unless you've got some serious insider knowledge, which, by the way, is illegal, you're playing a losing game. We live in a world obsessed with instant gratification. Want a pizza? 2 taps on your phone and it's at your door in 30 minutes. Want to watch the latest episode of that show everyone's talking about? Streaming services have you covered. This desire for immediate results bleeds into every aspect of our lives, including investing, and that's where things get dangerous. See, the stock market isn't some get-rich-quick scheme. It's a vehicle for building long-term wealth, and that takes time, discipline, and patience. The problem is, too many people approach investing like it's a slot machine in Vegas. They're chasing that quick dopamine hit, that thrill of seeing their portfolio skyrocket overnight. But when those gains don't materialize, or worse, when the market dips, They panic. They sell low, locking in losses, and missing out on the potential for long-term growth. Remember, time in the market is more important than timing the market. Think about it this way. Would you rather have $1 million today or a single penny that doubles in value every day for 30 days? It sounds crazy, but that penny, through the power of compounding, would turn into over $5 million. That's the magic of compound growth. It's slow and steady, like watching a tree grow. You might not see much change day to day, but over years and decades, the results can be astounding. But here's the catch: compounding takes time. It needs years, even decades, to really work its magic. When you're constantly jumping in and out of investments, chasing quick returns, you're essentially hitting the reset button on your compound growth. You're starting from scratch every time, and that's a recipe for staying stuck in the financial mud. Don't underestimate the power of patience and consistency in investing. So, how do you break free from the short-term thinking trap? It starts with shifting your mindset. Stop looking at the stock market as a casino, and start seeing it for what it truly is: a wealth-building machine. Focus on investing in quality companies with solid fundamentals, and hold on to those investments for the long haul. Don't get spooked by short-term market fluctuations. Remember, the stock market is like a roller coaster. It has its ups and downs, but over time, it generally trends upwards. The key is to ride out those dips, stay the course, and let your investments compound. That's how you build real, lasting wealth. Imagine setting out on a cross-country road trip without a map, GPS, or even a destination in mind. You just hop in the car and start driving. Sounds exciting, right? Maybe for an adventure movie, but in the real world you'd end up lost, frustrated, and nowhere near where you wanted to be. That's exactly what it's like investing without a plan. You might stumble upon some short-term wins, but without a clear direction, you're far more likely to make costly mistakes and fall short of your financial goals. A well-defined investment plan acts as your financial roadmap. It outlines your goals, risk tolerance, investment strategy, and helps you stay focused and disciplined, especially when the market throws curveballs your way. The first step in crafting your plan is to identify your financial goals. Are you saving for retirement, a down payment on a house, your kids' college education? Be specific. Write down your goals, the timeline for achieving them, and how much you need to invest to get there. Next, determine your risk tolerance. How comfortable are you with the ups and downs of the market? Your risk tolerance will influence your asset allocation, the mix of stocks, bonds, and other investments in your portfolio. Remember, higher potential returns typically come with higher risk and vice versa. Don't fall into the trap of chasing returns without understanding the risks involved. Once you have a plan in place, the key is to stick with it. Review your plan periodically, especially when your financial circumstances change, but avoid making impulsive decisions based on short-term market fluctuations or the latest investment fads. Remember, your plan is your roadmap to financial success. It's designed to help you navigate the inevitable market storms and come out ahead in the long run. Don't let emotions or lack of discipline derail you from achieving your financial goals. Stay focused, stay disciplined, and stick to the plan. It's not the market that defeats most investors, it's their mindset. But now you know the truth. You understand the psychological traps that can sabotage your financial success, and more importantly, you have the tools to overcome them. If you're ready to build real wealth with a long-term mindset, hit like, subscribe, and comment below. I choose discipline over emotion. Download your free investor psychology guide at invesYou.com. It's packed with even more insights and actionable strategies to help you master your money mindset. If you found this video helpful, give it a thumbs up to help more people discover it. And for more actionable insights on growing your money, make sure to subscribe to invesYou. Please check out our next video, the 7 investing mistakes beginners always make.